Hey there, everyone. It's PJ Patterson here, the chairman of the IFBF. And I just wanted to quickly reshoot the video around Loom. Fortunately, I didn't have the record button on at our last meeting where I presented on this topic. So I wanted to record it so we could bookend that onto the meeting from October, as well as maybe this will be a separate video in and of itself. We'll see what JJ does with it. And in any case, I wanted to just revisit again for you why I think Loom is one of those things everyone should be using in their business. So I'm specifically talking about loom.com, this website here, Loom. Now, there are others out there. I think there was one or two mentioned, at least one mentioned, which I cannot remember its name, but I'm sure if you Googled similar software or similar programs to Loom, you'll probably get a few hits. But I chose Loom. I think it works really well. It's reasonably priced, and I find that it's very, very easy to use. So I'll just quickly click on the pricing. I think I've got this business version here, $10 a month US or $8 a month US if you do an annual subscription. Really, really cheap, and you get a number of things you can do with it. And it also gives you basically unlimited videos as well, which save to your Loom backend. So anyway, I'm just going to jump over to the actual Loom site. So this is my site here, or not my site, but my login to Loom. And I think I've done over 500 videos in the last probably year and a bit. I'm not sure what the oldest one is, but easily a year and a half, maybe even 2 years worth of videos on Loom, 500 of them. And the thing that I think is most powerful about Loom is, think about this right now, right? You are watching me deliver a video on Loom. Now imagine if you and your business did the same thing. You're talking directly to a customer, and it's obviously just a one-way conversation, but you're bouncing around the screen and you're saying, let's have a look at your funding position. This is your deposit. Here's how much you want to borrow. This is, we got the green tick. I'm speaking specifically about the way Connective's Mercury software works. I'm sure they're all very similar, but anyway, you get a green tick there showing you've got plenty of surplus funds, etc., and run a client through that. Or for that matter, a borrowing capacity. You generate the borrowing capacity, you have it on your screen. You got the little bubble just like I've got here down in the corner, and you're saying to the client, this is fantastic. We've got all these lenders we can choose from, but here's a couple of my recommendations on lenders. You can do the same thing with borrowing capacity or product comparison. I'm not sure which one I just said there, but all three of those things you can easily go through in a video, as opposed to writing a War and Peace novel on an email. So I think you say so much more and convey so much more in a video message, and it's much more personal as well than if you put things into an email, write it out. Also, the time it takes you to do something like this is, I think, even less, although you'll probably end up talking a bit more because you probably run out of things you want to type. But again, the message and the tone and the way you are expressing yourself come across so much better in video, I feel, than just basically now what I think is impersonal, which is the email. So again, I think that a tool like this, whether it's Loom or whether it's some other tool that's available out there, is best practice. The best brokerages and firms are using this type of communication and this type of tool to differentiate themselves. And look, we all know that the market share of brokers is probably hovering somewhere between 55 and 60% right now, give or take. And it's going to grow. So that means there's going to be more and more brokers out there vying for business. My question for you as an IFBF member is, what are you doing to differentiate yourself and your business to your clients? I will absolutely, I promise you, I guarantee that if you start utilizing this form of technology and this form of communication, not only will you wow your clients, like they will be like, wow, that is awesome, very informative. They can obviously review it. They can go back, rewind, revisit, do whatever. It's a permanent record out there. But not only will you wow your clients, but they will realize that no one else is doing this for them. The number of firms out there that are using video is minimal compared to the ones that are the good firms that are doing it. So very, very few, in other words, very, very few of our cohort, of our colleagues, are utilizing this sort of technology and this sort of tool. So my message to you is very, very simple. It is to embrace the video and to utilize something like Loom to do it. Now, I have a bit of a different studio setup here, and I'm recording this on some real high quality stuff. So as you can see, I've got a boom mic here, and I've invested a little bit in the technology around this stuff. But generally, I don't record any of my videos to clients on all of this stuff. I've got my Logi or Logitech camera sitting on top of my monitor here, and it's got a microphone built into it. And typically, what I'll do is from my laptop, which is in a different room in my office, but my computer, my other desktop, I will just record my videos, do what I need to do on the screen, and I'll send it to clients. Very simple, straightforward, and personal. So please invest some time, practice if you need to. If you're uncomfortable doing videos, just practice. Just shoot a video like this, save it, and watch it back. You will learn a lot actually by doing that. And I guess my final message, and please don't take a page out of this. Make sure you don't take a page out of my book of talking too much, but certainly you don't want to talk too much in your videos. You want to get to the point, give them the message, let them see how passionate, excited, or maybe frustrated you are. There's no reason why you couldn't convey some more negative emotions in a video if that's truly how you felt about something. Concern even. You can express that, saying to a client, look, I'm really concerned about you doing this. And I'm telling you now, the cut through you will get and the power that you will bring to your business and your relationship with your clients in doing this, you will be rewarded many, many times over. So again, this is a best practice video for the IFBF members, and probably, again, it'll end up out there in the ether, I'm sure, but it is a massive endorsement for best practice using video to convey and message things to your clients. So that's one very powerful way to do it. The other thing I do with it, of course, is I record all of my IFBF messages. As you can see, I've got a green screen here behind me. So what happens is JJ, who does all the digital marketing stuff for me, he'll throw an image on the back of that and do all the other bits and pieces. That's, again, a bit more sophisticated for most people, but it's obviously doable and possible. And then finally, I do newslettery type stuff, market updates and things. As you know, I have a financial planning business, so I'm often doing my market updates and things on a weekly basis for clients. So to recap, best practices. First of all, embrace video, use it as a messaging tool. Start flicking emails. Don't do that, and actually go ahead and shoot them a video. Now, I can't really show you this without killing the video, but the way you do that actually is you would just fire up your email. You'd get an email open, and then once the video is recorded, and I'll hit the tick mark here, you'll have this video here. And what will happen is you'll click on a link. So you'll rename the video, whatever it is, borrowing capacity, there you go, investment performance review. As you can see, a couple of key things there, update on some project work that I'm doing on a project. And then you click a link and you drop it in your email. And what actually happens is it pre-populates the video already. You don't have to do anything with code or anything like that. It's really, really schmick. And then you just email it off. Awesome. And obviously putting attachments with it that you want to share if you're doing things like I described earlier, the product comparisons or the borrowing capacities, those sorts of things. So you will need to attach those, but it is so easy to use. Even a novice like me, back when I began using this, can pull it off. So if I can pull it off, anybody else can pull it off. So with that, I'm going to wrap up this video. Please, again, consider adopting a video strategy for your messaging to your clients. Make it personable, make it real. They will love it, and I think you'll find that you'll love it too. Take care. Thanks very much. I agree. I know we've got a question from Michelle. Just before I get to that, because it's a bit of an essay, so I'm going to have to read the question and kind of get down to the brass tacks here. What I did want to pick up on something you just said though around clawback. Which clawback's always been a concern of mine, because I think the clawback provisions that lenders have are quite onerous on the broker, and especially now that we've seen reduced trail. Upfronts came back during the GFC, and after that, I think the broker is in a tough spot right here, because if we can't, say, claw back after 8 or 9 or 10 months, if a borrower chooses to leave, that puts us out of pocket. I think it's unfair. So what conversations are you having with lenders to, and I know some of them are already doing this, but what conversations is Outsource Financial having with your panel lenders to say, hey, we got to really revisit this clawback thing and maybe make it a little bit more equitable for the brokers?
Yeah, look, I've had many discussions about this clawback, not just with the lenders, but as the industry. I've always said clawbacks aren't going to go away. Will they be amended? Yes. But what I've said time and time again, PJ, is that lenders are open to waiving a clawback in specific situations. We've had it. We do not have an issue with clawbacks at Outsource. Now everyone to go, oh yeah, of course you don't, but we don't. Because what happens is, if there is a situation that is totally outside the realms of the broker, and we believe that there's room that nothing could have been done, then we will apply to the lender to have it waived. Now, we've had many waived for our members, but why I don't think clawback will ever go, PJ, yes, as I said, it'll be fine tweaked, but it's not going anywhere, as has been proven in the last few months. Because back in the day, and we've all, some of us back in the day, we've got to ensure that there's just not this churning, jumping from a lower rate to a lower rate to a lower rate to a lower rate. Okay, clawback is there for a reason, and that's what it was originally put in there for a reason, to stop the churning, one component. So look, probably the wrong person to ask this, whilst I've always believed that clawbacks will stay. What we have to realise is that lenders are flexible when it comes to certain situations. So we either work with them, and they've put up their hand, a lot of them have put up their hand and said, if there is a really good reason, and it was totally outside the realms of the mortgage broker's circumstance, we will waive it. And I think that's the best we're going to get.
Right. So just to be clear, I'm not advocating that clawback be removed. I guess what I'm asking really is, some lenders are already now looking at, for example, a monthly runoff of the amount that gets clawed back, things of that nature, as opposed to this 12 and 18, 24 month deal where it's 100% first 12, 50% after 18,
Yeah.
and I guess 0 at 24, which I think is not very equitable at all, because of course the bank makes money as well along that time frame. I just think the opportunity now exists for us to actually have that conversation with lenders to say, well, what is actually fair? How do we make this a viable industry? Because if we are not able to claw back our livelihood from a client who, for whatever reason, has exited their mortgage prior to the period within which clawback no longer applies, we don't work for free. And the other alternative, of course, is that we charge a fee, and that seems to have gone down like a lead balloon in the industry, as well as the idea that we would charge a fee. I don't know, do you have any brokers that are charging fees and have just, are rebating commission, or not, not charging any commission at all?
Well, no, I mean, mandate is another story. So, but just quickly back on the clawback situation. Yes, as we saw, Bankwest have come out, and it'll be the sliding scale. I think we'll see some innovative situations going forward. This industry's changing. We're in uncharted waters at the moment. So anything can happen. And I do believe that the clawback will be fine tweaked to suit, I guess, everyone. On the mandate side, again, at Outsource Financial, our members are not allowed to charge a mandate, except, right, so the only time you should even look at charging a mandate and take away commercial, because that's just normal in that space. But in the residential space, where you're getting an upfront and a trail, if you believe, hand on heart, that consumer is just shopping around, and you're going to do all this work, and then they're just going to take all your information and just go directly to a bank, we allow our members to charge a mandate Not a big mandate, but something. But if that client goes with them and it goes through to settlement, then they rebate that mandate.
Sure. Okay.
And
That's
the
interesting.
last thing we want, PJ, we've done a lot of work on this industry to ensure that we are at a very high level professionally.
Mm,
A lot of work has gone into it from the whole industry, mortgage brokers included.
yeah.
The last thing we want to be labelled as is money-hungry brokers.
Sure. Yeah, we have come a long way, and we're certainly, you know, the fact that almost 60% of mortgages are written by brokers pretty much speaks for itself. When I joined the industry, it was about 23%. So
Yeah.
we clearly have demonstrated our value proposition. I just wanted to, I suppose, pick back up on the idea of charging, I guess, charging a fee. Do you think that mortgage brokers now are finally getting the recognition that we are actually advisors as opposed to just a transactional person?
I think you have to be very, very careful with the terminology, especially with ASIC. An advisor is like a wealth advisor under the AFSL side of things. And that's what we do not want to go down the path of. I think what our industry has now shown that we are professionals. That we're
That mean
professional.
exactly. I just want to pick you up on that, Tanya, for a second, because I've long held the view, and I'll have to respectfully disagree, that we are advisors, because we really do add a lot of value in the transaction. We don't just take an order from you. You know, Tanya says to PJ, "I want a variable rate mortgage. This is what I want.
Yeah.
I want you to go to this lender." Our job is to present information to borrowers so that they can make an educated decision. Now, if that isn't an advisor, I don't know what is. Notwithstanding all the FSL stuff, I get it, but you know, I guess what I'm really asking is there an opportunity now that we've built all this great credibility and that we are now at the precipice of being able to say we act in the best interests of clients? That is now mandated. Can we really go out and start this conversation saying we're actually an advisor? This is what we advise around.
I think be very careful. I think you're walking on dangerous grounds there with ASIC. And that's why the industry as a whole removed that word advisor. Because it's very dangerous grounds, PJ. What this industry has is created that we are professionals. We are specialists, and I noticed, I think, Sophie, that came up, credit special. We are specialists. We give credit guidance. We give credit assistance. And you said two big words that I'm a major fan of. Consumer education. So our role as a professional is to educate the consumer on the whole process, educate them. Our role as a professional is to sit down with that consumer and give them a choice of lenders, give them comparisons of lenders. And then it will be, at the end of the day, up to the consumer to choose which one suits their best interests and their wants and their needs. But it's the professional mortgage broker that will be giving them all the information and all the data. Data is gold. And that's what the mortgage broker's role is, to be professional, ethical, but now they also become an educator. And I think that's the three big things. I am totally against the word advisor. As I said, dangerous grounds we step on.
Sure. Okay. Fair enough. Now we've got just a couple minutes left. Now, Michelle was asking about responsible lending and let's see, and compliance. Michelle, you just want to come off mute and just give me the 10-second, question that you wanted to ask Tanya.
Yeah, sure thing. Hi, Tan. How you going?
Hi, mate. How you going?
Yeah, good. Look, being in compliance myself, I've had discussions with, brokers, and I think with the Treasurer scrapping the responsible lending guidelines, I think there might be a bit of misconception out there, because I think some of the feedback I've been getting is, oh, well, responsible lending won't be an issue in March next year type of thing. And it's like, well, hang on, you still will, have to adhere to certain things. And the other thing, I just want your thoughts or recommendations to brokers around this, because the other issue with BID was that a lot of, some brokers I've spoken to haven't actually decided to put any changes into their processes. What would you recommend in that area?
I think if brokers have learned anything from what this industry has gone through, they'll ensure that they don't drop the ball. We as an industry aren't going to drop the ball. Now, just because responsible lending's been scrapped on the banks, and just let me read something. That is, you're right. From the 1st of March 2021, lenders will be able to rely on information supplied by a borrower, whereas currently they are required to verify this information. It's not yet apparent just whether this will extend to mortgage brokers. Let me give you one big fat tip. That mortgage brokers will be required to do their due diligence. And if anybody's thinking of dropping the ball, don't. Again, that's a very dangerous thought process. You are required, because you're the broker, to do your due diligence. And hence, that's why we've seen such a major spike in the likes of offerings like Equifax, Ilion, CashDeck, things like that, because the mortgage broker is the one collating all the information, then they're putting it together, lighting it up and giving it to the lender. So the lender is going to be looking to the mortgage broker, the person that has collated all that information, and you're going to be responsible and accountable to saying, well, we've done tick, 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 tick to ensure that, yes, we confirmed this. Yes, we've clarified this. Yes, 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 yes. So we cannot drop the ball in this industry. We've come too far and we've raised really great levels, and that's where we're going to stay. So if people don't plan to put anything other than what they're doing, or if the mortgage brokers that are doing all this, heads up, you're going well, and you'll do really well, because you think the lenders aren't going to come back on the mortgage broker and saying, well, this is a fraudulent bank statement. What did you do to clarify this? And you go, oh, I didn't know. You know,
well,
that's
that
what
just
the consumer gave me.
Yeah, that just proves that they're going by their word and not doing their due diligence. And it's a fuzzy
and I
thing,
keep
that
on
due
saying,
diligence.
Yep, you're right, Mish. I keep on saying the double D word. That will protect your backside. If you ever get called into a lender audit or an aggregator audit, the first thing our head of governance does, and remember, we've provided all these kind of checklists and everything for our members. So at Outsource, there's no excuse for not doing anything
At
like
outsource,
this.
there's no excuse, but not all aggregators do as well as what you guys do. So, you know, I think some have a little bit less, some have more, but it's a matter of just, you know, you've got to be aware, I guess, of what you're, and it's all the documentation. Yes, it's time consuming, but at the end of the day, it saves a lot of.
So, and exactly. For us at Outsource, our main objective is to ensure that we protect our members, our mortgage brokers. And we have a very strong compliance, probably one of the top, our lenders love our compliance because it's so good. And anybody that's been called into a lender audit and they've gone, you know, well, we've had a couple of queries around about this. Our members go, let me show you our due diligence. And, oh, how did you clarify that? Oh, well, this is how we clarify that. Then at the end of the day, the lender goes, your accreditation's safe. Because that's what's going to come down to. You have to protect your business and you have to protect your livelihood. And the only way you're going to do that is to ensure you have strong compliance components around it.
And again, in a court of law,
silly.
at the end of the day, they're going to ask you what happened in that conversation, as if you're going to remember. So at the end of the day, you've got to make sure that.
Again, Mish, it comes down to comprehensive notes.
Ladies, I'm going to have to interject. We have run out of time today, but that was a fantastic interchange. And I think, Tanya, just to lock it off, first of all, to say thank you very much for joining us today. It was a pleasure having you. But certainly, guys, the key takeaway I've heard from Tanya, obviously, is to do your due diligence. I know that has been a bit of a bane to the industry in the last few months, but it's probably going to come out the other side as being one of the best things that's ever happened, is really having to get stuck into it even more to make sure that we do our due diligence and not go backwards. So Tanya, thank you so much for being with us today. Feel free to stick around.
Thanks, PJ.
Yep, thank you. Cheers.
Thanks, everybody. It was a pleasure.
So that brings us, we got a couple minutes just quickly for morning tea. So I'm just going to take about a 3-minute break, and then we're going to be joined by Blake Buchanan, who I know is already in the room. So just a quick break, guys, and we'll be back in just a moment with Blake. Okay, we are back, and we are ready for Blake. Are you there, sir?
I certainly am, PJ. Thank you very much for having me. How are you?
I'm very well. There you are.
I am. I'm here.
You are, you're not with a backdrop. You are in the office, it looks like.
Yeah, look, you know, I could have my logos up behind the screen and treat this as a recruitment drive, but I'm not going to do that. That's not what you guys want to hear. You want to hear about the industry and what's going on, right?
Absolutely. I definitely want to hear about the industry, but feel free to give yourself a little plug as well. You know, we got to show the love from time to time to all the people that support us as well. So by all means, slip it in there at the appropriate time, which I know you're very good at these things. So you'll find the right moment. So on that note, give us an update from your perspective. What's happening at Specialist?
Yeah, right. So, so I can talk to you about the number of things that I think are important to brokers, but at any time you feel like I'm getting off track or you'd like me to speak about something specifically, you know, jump in.
Will do.
So, you know, over the last 5 years, really, since ASIC commenced their investigation into broker remuneration until today, has seen the biggest winds of change in our industry. We've had to be highly adaptable. We've had to be worried about ourselves, be worried about our consumers and our longevity helping consumers. To date, though, we've had a significant amount of wins. And I guess some of those costs are the additional workload that we carry with it, you know, the additional note keeping, the additional checks and balances, living expenses, I think largely brokers have come out of this unscathed, and I can validate that through the AFCA complaint data, whereby with regard to residential lending, brokers are consistently less than 1% of all complaints, whereas banks sit in between that 30 to 40% worth of those ratios. So that's a testament to the good work that brokers do, of course. I think a lot of brokers are curious about BID. They're not concerned about it, and they certainly shouldn't be concerned about it. As time's marched on in the course of the last 30 years, and you've got to remember, brokers have only been around for 30 years. We're a young industry, you know, but as time has marched on, largely the 90s were easy. The noughties were pretty easy, but we approached GFC, introduction of NCCP, and all of a sudden brokers had to shape up, you know. There were a few cowboys that had to leave the industry, but brokers had to get better at what they were doing. And so we saw a lot of this shift into more record keeping, more reasons why. And so that's been a journey for the last 10 years at least. Coming into BID, what we need to do is validate our choices. We need to document those choices. We need to ensure that they're on record. And the big component is for education as well. We need to educate clients, not just around our product recommendations for them, but sometimes even when we're not recommending a product, the reasons why we didn't recommend that product. So the encouragement here is to become much better note takers for BID. What we've done as a business, and we use similar systems to Tanya Sale, who just did a great job presenting, mind you. We've implemented 5 steps in our process, and it's not doubling up on needs analysis or fact finds. It will filter that data and fill it into those documents. So the first one is needs and objectives, obviously identifying those ones. Everybody knows how to do that. Product requirements, which is what the consumer not only needs today, but what's in their best interest for the future, making those product requirement selections, which will again filter your lists and present that list. Doing the analysis and assessment of that list and the education components of that list around why I'm going to put these ones into the ones that I recommend to my consumer and why I'm not going to put these ones in. The options are then presented to your clients, and we're ticking these boxes as we go along. They've been presented to your clients. These are the recommendations. This is how it all works. What say you? And then, of course, the signed authority to proceed. So largely, there's not going to be too many changes to what we're already doing. Maybe just a change in the way that we do it. Certainly more note taking, absolutely more note taking. And as you know, that comes into play January 1st. So that's probably BID.
Okay. Fantastic. I thought I would just, you said a lot in that last couple of minutes, and a couple of things I want to pick up on, and I want to hit you with something that we were sort of I was having an interesting interchange with Tanya on, and that was the idea that we are an advisor or not an advisor. And you used an important word in some of the things you just said there, which was at some point we make a recommendation to the client. Now, again, I don't know about you, Blake, or anyone else in this room, but if we're making a recommendation, it sounds an awful lot like we're giving advice. And so I thought I would get your take on that idea of whether or not we are actually an advisor and how specialist views that.
Listen, you know, I've got a little bit of a contract law background in some facets, and it really comes down to the definition, mate. No, we're not advisors. We're not telling clients what to do. We are recommending products. In some capacity, we are giving advice, but ultimately it's consumer choice. We are not saying this is the product that you go with.
Okay.
Our job is to, and you know how hard it is to be a finance broker or a mortgage broker, you know, with 30, 40, 50 different lenders on your panel with a swathe of different products each. There's thousands of the things to go through. In reality, we can't put that burden onto a consumer to navigate that market. That's what we're here for, to navigate, narrow down, make recommendations, and identify products that suit their needs. Once we present those 3 or 5, that by extension is our recommendation for those products. That's narrowing it right down. And if we make a selection out of that 5, that's our recommendation, but we are not saying you will go with that one.
Right. Okay. Sophie has given me a bit of shtick in here about in the chat room about being advisors and explaining to me why we need to move away from the term. I actually think we need to run towards it, frankly, because we are being regulated. I think her point in the chat, I don't know if you can see this, Blake, but is that we're on a path to being more regulated. We are. And so, you know, I mean, why not just go headlong into that whole thing and really raise our professionalism? Because we're kind of getting that anyway. Like, we're getting to the point where we're providing a lot of documentation that points to this is what we told the client to do. Maybe not the very specific thing, but maybe, as you said, Blake, the 3 or 4, you know, lenders or whatever that we came down to. So anyway, we'll maybe come back to that topic at another stage. Sounds like I should be on a panel somewhere.
Listen, if we move into the advisor space, we're going to open ourselves up to what happened in the financial planning space with FOFA Reforms 1 and 2, which has largely taken financial planners, made it harder for them to make money. It's given less access to normal consumers to go and see a financial planner, and it's made it more expensive for them. We don't want to go down that track. And like I said, when we're talking about these big transactions, the flow-on effects from terms like advisor is increased insurance costs, increased risks, so on and so forth. It's not what we do. I understand your position, but it's not what we do. If I can just move on to, if that's okay, and we'll take some questions.
Yeah, I want to move on. I was going to ask you about some other stuff, but go ahead. You have something to say, so all yours.
Yeah, so what I'll just talk to you about is what brokers are going through presently, and the most pressing concern being COVID. And I'll just give you some ideas that I have around it and what it means for the industry. So first of all, COVID is an awful thing. And, you know, our brothers and sisters in Melbourne, you know, they had 2 wins on the weekend and they've opened up. So there's a little bit of sun shining down there at the moment. It would have been better if Penrith won. But but COVID has been really, really good for the broking sector. So if we look at the BBSW, the bank bill swap rate, historically, it's at 0.9% today. Okay, the 90-day bank bill swap rate is what banks lend money at. It's a policy that sets the cost of funds, et cetera, et cetera. It hasn't been this low since 1969, and rarely has it gone below 1%. In 2018 to 19, it took a year for that bank bill swap rate to go from 2% down to 1%, a whole year to lose 1%. This year, it took 1 month to go from 1% down to 0.9%. And this goes to the credibility of the bank's strengths in margins. You obviously haven't seen interest rates drop by 1% over the course of the last 6 months, have you? So margins have been increased by some banks. That's okay. The flow-on effect problem for that is for the 2nd and 3rd tiers, where liquidity has been a bit of an issue. So the sustainability of banks has been phenomenal. On the back of COVID, we've seen ABS data reported to suggest that, you know, historically refinances make up about 40% of the market. More recently, that's 75% of the market. And some of the concerns that go along with that is that anybody that, you know, in their mind was considering refinancing in the next 12, 18 months, they were going to get to it. We might have been refinancing them in March. We've already done that. And that's why we've seen a huge inflow of refinances and volumes have gone through the roof. I know the market average for financial year was up about 12%. In the 10 months to this month, or the 9 months, I should say, with September reporting data, the market's at about 24%. As a business, we're in a different growth stage. We're about 68% for the same period. So we're growing really, really quickly, but brokers should be growing as well. You should be, on average, writing more business today than what you were writing last year by at least 20%. And if you're not, you need to contact your clients because they are refinancing. The average refinance period or termination for a broker introduced loan sits between 4.4 and 4.8 years. That is contracting down to about 4 years as people bring forward their refinances. What are the challenges? In 6 months' time, that refinance that was going to be there that's already been done, what's that going to be replaced with? And this again is where COVID has assisted us. We saw major banks with outsourced and offshored operations in customer service that went into hard lockdown. I'll just pick a name out and say Westpac. But Westpac customers are seeing all this hype about losing jobs. They're seeing interest rate reductions, mortgage repayment holidays. They're on the phone calling Westpac because 50% of customers still go straight to their bank. And they're calling Westpac and they're on hold. They're on hold for hours and they can't talk to anybody. So they Google it. How do I reduce my Westpac interest rate? And guess what comes up? Mortgage Choice, Aussie, AAA mortgages, Broker A, Broker C.
Yeah.
And they think to themselves, I've never used a broker, I'm going to try it. And so they pick up the phone and the broker says, let me see if I can help you get a rate reduction with Westpac, fill in this form. But there's much better options out there for you for your current situation. So on the back of this, we will see an increased broker market share. And for that broker market share, if we're doing 1.1 times, the normal broker isn't going to be doing 1.1 times. They're going to be doing more than that because the broker market is contracting as well. There's less and less brokers as technology gets better. Mm-hmm, mm-hmm. So COVID has brought into play technology as well. You see these brokers that, spend an hour getting ready, having a shower, dressing up, bit of research, hopping in the car, driving to their clients, coming back home, researching, getting undressed, unwound, putting all the stuff in and getting back to their clients. Those days are gone now. We were working to digital solution. COVID has accelerated that. Instead of seeing 2 customers a day, having a shower, getting ready, doing your research, you'll be able to see 5 or 6 customers a day. And with that, you will see consolidations of broker numbers in the market. So instead of doing that 1.1, because the market's grown by 1.1, you'll be doing 1.3 and 1.4 times the amount of work.
That's a very good thing to hear. And I think broadly speaking, our group, I think, has commented that they've been some of the busiest people ever in the last 6 or 12 months. I know I've certainly seen volumes increasing, and I think I can echo that sentiment across our group as well. So I think it's playing out absolutely as you've just explained it, which is great, which really is good. Now, just to pick up on something you just said there about people sitting on hold, you single out Westpac there, but I think we could probably say that for most of the larger lenders in Australia because they have provided a lot of the credit to Australians. So it's no surprise there, really. I'm not trying to be smart or pick on anybody, but do you think this is going to drive a little bit of now dispersion such that we see a lot of the regional banks and non-bank lenders now even picking up some of that slack because they have better SLAs, because they don't have to sit on hold for 2 hours to get through to someone to speak to about your mortgage? What are you seeing there?
Yeah, look, definitely. I mean, my phone's been ringing hot over the last few weeks with, all these new credit unions that have never had broker space before because they didn't believe in it. And now what they're seeing it is a very viable option. We're seeing groups like COBA coming out and, publicly fighting the banks on customer service and saying we're better. And they're competitive as well because that cost of fund that I described is so low at the moment. So they can come out. What we saw is a huge increase in big bank market share in the course of probably from September last year to July this year. And now it has, it's equaled again. So it's normal parameters because of these massive cashbacks. These massive cashbacks have driven these broker behaviors and client behaviors that run to them for $2,000, $3,000, $4,000. And that's okay. That's okay. And so what we saw is bank market share increases last year. And we saw broker market share reducing towards the back end of last year. But this year, it's going up again because of COVID, partly. Now, we can argue day and night what the cashbacks are for. It is a customer grab because when best interests come in, they need to insure themselves. And the insurance piece is this: brokers work to a customer's best interests. Banks aren't bound by it. So the banks are thinking, okay, well, if brokers are going to promote that and we can't, how are we going to get more customers now before that comes in? If we can't, under the legislation, give cashback incentive to get people to come across because brokers can't sell it, can we use it now up until bed implementation? So all these things are coming into play, which has been a massive grab at bank market share recently, but it expands and it contracts. So it has contracted now. It's getting back to normal levels. And what we're seeing are people like MoveBank, who is part of Cobra and bank and customer owned, with really great rates and really great policies and digitally enabled and all these cool things. So I think we will start to see that spread of big bank utilization drop just a little bit more over the course of the forwards.
Okay, no, that's interesting commentary. And just to, I suppose, reiterate something you've just said, and I know you didn't get the benefit at the beginning of this meeting, but I just gave about a 10-minute presentation on using video to really communicate with your clients. And I suppose something that Blake has just said around, getting out, guys, and talking to your clients. We talked about this at our last meeting. Gail Stevens did a great presentation on this. Is right now your clients are probably looking to refinance and to take advantage of all of these fantastic rates. So, if you're struggling for business right now and you're not seeing that incremental increase of, what was it, 20%, Blake? I think you said, at least?
Oh, that's market. So market this calendar year, we're up around 68%, mate. So we're 3 times market growth. But,
okay,
that was my
you're special, right? So that's good, right? But anyway, I suppose, okay, we'll split the difference and say if you haven't had at least 30% growth in your business, then you should probably start picking up the phone or sending some videos out or doing whatever. Moving on to another question and another topic that I think is concerning the industry right now, and that would be the upfront commission discussion and what lenders are, there's some noise out there that maybe upfronts will be in jeopardy, or we might have a flat, fee, everybody standardized, this sort of thing. What conversations or what are you hearing about the upfront commission, and are we gonna, continue to see that as part of our industry?
Yeah, look, I mean, it's an ever-evolving discussion, right? And if we go through the history of time, these were introduced at 1.5% upfronts. Citibank did that, and a couple of the other lenders. That really excluded a lot of lenders from playing in the market competition-wise. And I'll just explain to you very basically why. When a broker gets paid an upfront, it comes out of what's called Tier 1 capital, which means the bank has to borrow your upfront and pay it to you. When they pay you trail, that comes out of the proceeds of the loan, if that makes sense.
Yeah.
So when they borrow that money upfront to pay you, they buy that money that they've paid you over time. So they know they're going to recoup that upfront over a period of, say, 2 years, and anything beyond that is going to be profit. And this plays into a bigger conversation around clawbacks. Now, a lot of your members...
We were going to get there, don't worry.
Oh, good. But so basically, best interest bans conflicted remuneration. There's a conflict in everything that we do, as long as it's identified, disclosed, and it's not to the detriment or not in the customer's best interest, that's okay. If fee structures change, and there's been a lot of discussions with it, I was in Canberra multiple times, post-Royal Commission and post-election, discussing these things as in a consultancy type fashion. I've done work with ASIC on it. So I'm pretty abreast of some of the conversations, but what I'll say to you straight away is this is on the tip of everybody's tongues because Bankwest dropped their upfront commission yesterday or the day before this week, whatever it was. They also changed their clawback parameters to make it a linear one. So as you know, most banks or lenders charge 100% clawback year one and then it slips. What they're doing is they're saying, well, depending on which month it is, it slips, okay? Which is probably where we want it to go anyway. My preference is for a 12-month clawback. But every time we reduce the clawback period or reduce the clawback amounts, what we're doing is increasing the cost of risk to the bank that provides the loans. They need to account for that risk somehow. So if they account for that risk by putting their interest rates up to the borrower, that means you're going to sell less of their loans and they'll get less business. And so Bankwest, by dropping from, say, 0.7 to 0.6, has accounted for some of that additional risk in clawback changes by reducing the upfront commission, if that makes sense. So the reality is, if clawbacks go, your upfronts may go down as well, but certainly the interest rate to the customer or the borrower will go up. So I don't think it's a matter of saying when will clawbacks go. I think it's a matter of saying what is the right balance for clawbacks. So we'll work towards that. The conversation is around, I charge my client a mandate fee and I get a brokerage. Is that a conflict or not? Well, no, it's not. It depends on how you value your time and the service that you offer to your client, essentially. Do we see upfront commissions changing up or down? Depending on what happens with clawback in the forward 18 to 24 and beyond months. But certainly we will be going through a enumeration review again in the next couple of years. Yes. Now, I'll be completely transparent with everybody, some of the discussions that have been held. When you go and see a broker or a Treasury official asks a broker, what is trail? Half of the brokers say, It's an offset of the upfront commission. That's what it is. That's my upfront commission paid over time. Other people say that's our client management fee. And there's a very small people that say, that's just what we get. You know, we don't have to do anything for it. The reality though is, if it is an offset of your upfront commission and I have the same customer times 2 and one refinances in 3 years and one sells their property in 5 years, what does the broker earn? It's a different amount. So you can't say that trail is an offset of the upfront commission because they'll argue and challenge you, and you can't win that argument. Mm-hmm. So what they're saying is, so how do you put a value on the service that a broker imparts on their consumers? How do you do it? And with the offset methodology, you can't. So you can say, well, it's an ongoing management fee thing. And then they say, okay, so for that management, then we have to impose these behaviours and regulate these behaviours. And if we do that, it has to be in adherence with best interest duty. And if we do that and you're doing annual reviews, you're going to get bloody clawed back all the time. It's ridiculous. Mm-hmm, mm-hmm. So what one of the concepts that has been presented is to say, okay, the value of a broker, like a real estate agent that might charge 2% on average, the value of a broker, for argument's sake, might be 1.5%. So instead of brokers getting, 0.7 and 0.15 trail for eternity, they might get 0.75 upfront and 0.15 for the first 5 years of that transaction. Because then you can say trail is an offset of the upfront component. It is time bound. And so we do get paid for our time and our service over that period.
Okay, very interesting. I like your take on that, and it's certainly glad to hear. For example, one of the things you mentioned there was charging the client a fee, a mandate. I know Tanya was quite passionate about the fact that outsource doesn't allow that, except in extreme circumstances. You have to justify it. Sounds like you're a bit more liberal as specialists in terms of saying to your brokers, if you are going to add a lot of value, you have a very complex deal, and we all know, there's a lot of complex clients out there that are going to take a lot of hours to sift through a deal. Maybe we should get paid a little bit extra to that and be able to charge the client. So I think you've probably struck a great middle ground there. Guys, if there's any questions for Blake, please drop those in the chat. We do have a few more minutes to go with him. Now, one of the things, and Nissan has just mentioned here in the chat, is that we're the only industry in the country that gets clawback. We're actually not. So as many of you know, I'm a financial planner, and I can assure you that if I write an insurance policy and that client cancels or whatever within the first 12 months, I definitely have some sort of clawback that I get hit with. So we're definitely not the only one, but it's probably not quite as onerous on the insurance side of things.
Well, it's not right, and it's not right. It is right to say that, but it's also not, because even if you're in manufacture, right? So you manufacture an order, you send it out, they might not like it, and they send it back. Particularly if it's in technology, you are bound by the acts to repay that client, even though you built it for them. You're bound by the acts to give them a refund. So in some sense, that is a clawback, sure. As well.
Well, there's holdbacks and other things in other industries. I mean, we could debate that all day, but the fact of the matter is we're certainly a unique industry where we seem to be, constantly having this discussion around clawback and the such like.
Nissan raises, and I know Nissan, so I'll say g'day, raises some valid points there, right? So you might not have heard what I earlier said, but clawback pays into the costs of a loan. It's fundamentally important. There's no way of getting around that. If we remove clawback, then interest rates will go up or our commissions will go down. That's it. If commission rates go up, do we then create a two-tier banking system? Whereas if I go to CBA and I get 4%, but if a broker does it, it gets 4.2% because of the additional risk of clawback being removed.
Yeah.
So we have to consider those things. And on his second point about commercial brokers are paid differently. So it's not a marginalised fee. Commercial, sometimes it is, mind you, but a lot of the time it comes out of an application fee. That fee is non-refundable to the consumer for starters, and so brokers paid out of that. And then if they take a trail, so be it. And if they take a marginalised fee up front, some commercial funders will cause clawback as well. And so it is a bit of a mixed bag. I think it's a matter of we don't like it, but we have to be very, very careful of what we wish for. And the consequences that aren't even unintended, we know what they'll be. It'll be a two-tier banking system, less commissions or higher rates for your customers. That's it.
Yeah, and unfortunately, we kind of have to leave it there. But just to lock it off, I want to make sure, because we are recording this, right, that you're clear on, and everyone in the room is clear that the IFBF isn't saying that we should, abolish clawback. I think what we're saying, certainly not what I'm saying, is we need to have that discussion as to figure out, what's the fairest way to appropriate it and deal with it. And your explanation of the capital and how, it's there's a capital expense, and then trail comes out of cash flow. Fantastic. I never actually even thought of it that way. So you've helped me today, and I've been in the game for a long, long time. So thanks very much for that. Guys, thanks, Blake. It's been a pleasure having you. We'll love to have you back in the new year as well, after best interest duty gets implemented, and we see if any of the shits hit the fan next year, and what goes on. So guys, put your hands together for Blake. Thanks a lot, bud, for joining us. Appreciate it, as always. Now, guys, just before we move on to Mark Heron, who isn't in the room yet, and feel free to stay with us, Blake, if you have time. Otherwise, I think you had another engagement, so bail if you need to. But again, thank you. I'd like to grab Frank. Are you in the house, Frank? Take yourself off mute, bud. Can't hear you. You're talking. No one can hear you. Take yourself off mute. He's probably asking me how you do that. Okay. Well, there we go. Zoe to the rescue. There you go. All right. So, Frank, you've got a very special offer, I believe, for IFBF members and the such like. Would you like to tell us about that, please?
Thank you, PJ. Morning, everyone. Yes, we're refiring a nice little competition thing we put up on our website some months ago and was popular. We do, one of the many services we offer brokers is a scenario system where they can send us the parameters and we can provide them back with their 3 most likely funders, which slides into your due diligence thing as well. So that's a separate service we run, and it can be part of a loan process or just simply an independent, give us 3 scenario most possible lenders. That's the idea. Now, we've got 3 of those on offer during the month of November. So if you just look into trailminders.com.au, and you'll see on the front page, you can log in there, and 3 brokers will win before our November 27 event, 3 separate scenario prizes. So you can fold that into one of your loans. And the third thing, the other thing is that we also do a lot of loan processing, from very by the hour short jobs to the full from the client meet onwards and through to settlement. And one of those full processing jobs for a resi loan, we'll give away for free this month as well. So very easy to just drop your email and telephone number up on the site. And at the Christmas function on the 27th, we'll announce who'll win 3 scenario prizes and 1 full loan processing. So a little bit early Christmas present. Thank you, PJ.
Wonderful. Thank you, Frank. And for those of you who were not in the early part of the meeting, just a quick rundown on the Christmas party. We are having a physical Christmas party this year at the McCure in Parramatta. It's been thus far open for the members to register because, of course, if you're a member of the IFBF, you automatically get a ticket to the Christmas party. So why wouldn't you show up is my question. But anyway, not everyone's registered. So you've got until close of business today to register yourself if you are already a member. And here's a little hint: if you're not a member, join, and then you can register for the party. Anyway, I'm not going to tell you how to suck eggs, but after that, it will be open slather, first in, best dressed. If you're a member and you didn't register your spot, guess what? Too bad, you missed out. You've been given plenty of time to do it. So please don't waste any more time. Do it as soon as the meeting finishes today. Jump in and register for the Christmas party. The reason, of course, is because we only have 70 spots because of COVID. We're restricted on that. So if you want to come and hang out with some cool human beings, the steering committee, all of us, and put down a few bevies and enjoy, hopefully, a very sunny afternoon at the McCure, then please register for the party. Now, where's my mate Warren? Are you in the house still? Okay, take yourself off mute. Tell us a little bit about this Terry Ryder thing, or you mentioned something earlier that you wanted to share with us.
I did. Thank you, PJ. Can you hear me?
Can hear you, yes.
Okay, great. Look, as Blake and Tanya and basically everybody has alluded to, what the COVID-19 pandemic has done in terms of bringing in digital solutions has had its impact on property as well. So as Laurie and PJ and I were talking at the beginning, when you've got so much government stimulus going on at the moment, and people are actually starting to look regionally now to live, which is something that our panel or we have not really looked at in terms of investment stock. So on the Wednesday, the 11th, and I will post in the chat box a link. I don't have everybody's email address, but I will post the link into the chat box that you can then register, or you're more than welcome to forward to your clients. There is a section that they have to fill in as to who referred them. But in the webinar, we really want to be able to dissect these new growth markets and reveal what the panel, and indeed, I'm sure most of you would have heard of Terry Ryder from Hotspotting. He's going to be our guest speaker. He used to be the writer on the Australian real estate. He's been doing it for 30 years. He was the editor of the property section in the Courier Mail and for the Australian Financial Review. He really is a very, very knowledgeable man and has been doing this type of forecasting for 30 years. So we're going to have him as a guest speaker. We will share what his forecasts are, which have been very interesting in terms of where that regional uptake has come. After talking with Laurie a little bit earlier today, it's not only first homeowners. You're more than welcome to forward it to your clients. I will put that link in there now, and really hope you can join us on the night. The education evenings have been fabulous. We've just done a virtual Dine and Learn for Eric, which has had tremendous results. But the education as to what is happening in the property market is best left with the experts, not with mainstream media. So I hope you can join us on the night. And that's it from me. Thank you, PJ.
Awesome. Thanks a lot, Warren. And for those of you who's heard of Terry Ryder, by the way, hands up, Terry Ryder. Hands up, hands up. Show me hands. Terry Ryder. Show me hands.
No one?
Half the group's on and their videos off. Okay, so those guys are all, who knows what they're doing. They're probably out mowing the yard or something. So guys, if you haven't heard of Terry Ryder, he is as Warren said, he is one of the preeminent experts, independent, by the way, researchers on property trends in Australia. He's been putting out research for years. I've bought many of his reports over the years. He is really fantastic at the detail, the research, and everything he provides. So let me tell you, if you're in this business and you don't know who Terry Ryder is, please explain, as a politician once said. So guys, Terry Ryder, Hotspotting, I think hotspotting.com.au probably is still the name of his business. Warren, is that correct?
That is correct.
Yeah. So, and of course, if you want to avail yourself of this other opportunity with Meridian, big opportunity there with Terry Ryder coming on to tell us about what's going on in the market. And there's some real interesting stuff going on, by the way. There's another guy that I deal with that speaks a lot with Terry, and I can tell you there's some real serious hotspots going on.
And it's absolutely fascinating. It really has. And this pandemic has brought forward probably where we would have been in terms of digital communication in 15 years' time, but it's happening now.
Sure is. And
the
the workforce, I reckon it's going to change the complexion of CBDs, et cetera. So some very interesting changes are going to be coming down the pike. Now, I'm just keeping an eye out for the waiting room. Mark has not jumped in yet, so hopefully he'll be joining us here in just a moment. Or is he in the room? Maybe he is. Mark Heron, please stand up. Please stand up. For those of you who are too old, which would be a couple people in this room, that is Eminem's song, by the way. Eric knows. He's shaking his head. Anyway, sorry, we're digressing. So while I wait for Mark to join us, what's happening at Deposit Assure? Are you guys seeing volumes up, Margie?
Yes, no, definitely. It's sort of that time of the year when everyone's trying to get in before Christmas. So we're definitely expecting a busy next couple months leading up to that. But we've actually got some exciting things coming up in the next couple weeks. So just keep an eye out for any announcements. So yeah, I can't say too much, but keep an eye out.
Okay. Woo. Always leave them wanting something. Well done. That's a great tip. Now, I think I've just let Mark into the room on an iPhone. Mark, is that you? Yeah, I'm not sure. Maybe he's still trying to join. Oh, yes, there you are.
I'm here.
I see you.
Thanks, PJ.
How you going?
Good. Apologies, as I mentioned, I'm in transit. I've got to get to a meeting at 12:30, but good to join you all. Hope everyone's well.
Yes, we are indeed. Thank you for joining us today. I really appreciate it. I think some congratulations are in order. I believe you've been named to one of the industry boards. Is it Lixie or something? Is that?
Yeah, Lixie's the latest thing I get to enjoy. So
'cause you're not busy enough, of course.
Well, yeah, yes, that's one of the things. Yeah, but you got to stay to stay on top of my game, I've got to stay ahead of the game. So,
Man, I've got to say, you're looking very Colin Farrell, The Gentleman. Not sure if you've seen that movie with the glasses. All you need is the
yes,
cap, and you know, and you're there. You're the character from that movie, I reckon.
well, you're wearing my Colin Farrell jacket there, PJ. And if I could fight like him, I think the industry would be in a much better shape. But anyway, let's just there'll be a few more. There might be a few more dead bodies floating around.
Yeah. Well, we digress. We're of course not here to talk about dead bodies and movies, but anyway, tell us what's happening from your perspective in the industry. What are you seeing out there? First of all, I suppose that are good positive things that have happened to this point, and then maybe if there's anything that's concerning you going forward as well.
Well, look, the changes to responsible lending laws in next year, excuse me, for the first quarter of next year is it's going to be interesting to see how that goes from a government perspective, how much opposition they get, and then what finally flows through. But they're pretty adamant it will be removed for brokers, it will be removed for lenders. But there's going to be this APRA already have a significant control mechanism on lenders and how they lend money. If, for example, the assessment rate, the plug rate for serviceability, that is primarily guided and set by APRA. And as we saw, that got adjusted from a 7.25 down to a 2 to 2.5% on top of the rate. So they've already sort of made that's that type of control mechanism. So they may go a little bit further in terms of some of their guidance around serviceability requirements, which then may and that will set the standard, that will set the bar. But from a broker perspective, I think removing that the onerous component of responsible in terms of all of the details that we had to gather from the customers around every single little thing. How many times did they have takeaway food? How many pets do they have? How many? I mean, children are very important. But you know, pets. You know, all these other things. You know, subscriptions to various accounts. Taking all that noise away, focusing in on what we call core expenses, and then using the lender's serviceability calculators. That will make, I believe, our job that much easier, and we can focus on what the customer wants. What's the customer's expectations and requirements? Because we're going to be pretty busy with best interest duty to meet that obligation and to document that well.
Okay. Are there any anything that is really concerning you going forward, I suppose, for the next maybe 3 to 6 months that you're worried about in the industry?
Look, channel conflict is still a challenge, and I see it. It's risen up again, and it's more.
We've just lost you there. He's probably going from the home Wi-Fi to the tower. This is the Mark Heron reality show, by the way, that we're watching. So hopefully he'll click back in a sec. Are you still with us?
Oh,
there
sorry,
you go.
mate.
You're back. You're back.
Yeah,
I think you went from
am.
home Wi-Fi to the tower. So you're back now. We just missed the last 30 seconds.
Yeah,
of what
sorry, mate. Okay, so my concerns are channel conflict creeping back in.
Yep.
And where my concerns are coming here is we saw a little bit of it in terms of there was not the same parity between service levels with some lenders whose turnaround times blew out. But of course, through their branch of the proprietary channels, they can still meet faster turnaround times because they're in their system and they've got delegations there. So we can't do much about that, but that's going to get all back on track, and we should have a bit more parity there. But my concerns are, and just a sort of a heads up to brokers, just to be very cognizant of this. I've had a few examples in the last 2 weeks where brokers are going back to existing lenders to renegotiate for their customers on the rate, doing the right thing, trying to keep the customer with the existing bank. But then that lender either doesn't come to the party or doesn't come to the party very much. And so the choice then from the customer is, well, let's refinance, let's go get that much better rate from that perspective. They then do all the organisation, organise the refinance, and then as the discharge request is put through by the new lender, the existing lender comes in and just undercuts everything and offers a rate that was not on offer in the first place. So I guess as brokers, just be cognizant of this, be aware of it, keep an eye out for that, make sure you're talking to your customer and communicating, and push as hard as you can with the existing bank, document it really well, so that if the bank does come back and make that extra offer, you've got the original conversation and the documentation, and then give it to your aggregator who can then challenge that with the existing bank and try and make sure that we get it sorted as best we can.
Good, good. Well, that's good advice. And I think you were aware of this, but we had Tanya Sale from Outsource and Blake Buchanan from Specialist on just before you. And one of the key things Tanya highlighted was due diligence and making sure that you're documenting and everything else. So it's good to hear that Connective has got the same, the same approach. I wanted just to touch on very quickly the whole clawback situation. I've also spoken with Tanya and with Blake about clawback. What are you conversations are you having right now, if any, with lenders about adjusting, clawback schedules and things of that nature? I'll let you get your seatbelt on first and get buttoned up before you tackle that question. Yep, he's dropped again. Another tower change.
BJ, still got me?
Yep, we still got you.
Oh,
Just want
great.
to make sure you're safe in the car and all buttoned up. You got your chauffeur there taking you to the next
I'm not
meeting?
driving. I'm not driving. No, that's for sure.
That's good.
Look, clawbacks, yeah, I'm having constant conversations. I'm very careful not to discuss too much of that publicly because, there's a lot of negotiations going on behind the scene. But look, given how many brokers Connective has, the amount of business we do with each lender, we're trying to use that as leverage in terms of our discussions with lenders as much as possible.
Good, good. I was hoping you might say something like that. I mean, one of the things that in our conversations I've already had today with Tanya and Blake was this idea that maybe we wanted to see clawback abolished, which isn't the case. We just want to make sure that it's fair and equitable, for everyone.
Yeah.
So, do you think that is the direction that you're heading?
Yes, definitely. Well, we saw some tweaking and a little bit of adjustment from Bank West this week.
Mm-hmm.
So we hope that a lot of other lenders are looking at it. That's all I can say at this stage. A lot of lenders are paying a lot more attention to this at the moment. It's been called out in the last meeting that Daniel O and I had with ASIC. It was something that was called out there from the perspective that the variation between clawback structures is actually also creating a conflict for brokers in that everyone looks at, okay, there's a difference between upfronts and brokers will go where the highest upfront is. Now, we know that is not the case. Similarly, there are some lenders that have harsher clawbacks and do brokers avoid them in certain circumstances. And that's what we've got to make sure that we have the regulators understanding so that they could also help us on that pathway to ensuring that we've got fairer structures, both upfronts and clawbacks. And obviously what trail seems to be, trail is a big thing that's been left alone, but that's the next discussion in 2022 when we do the commission review.
Yep.
It will primarily be around not whether or not commissions stay, it'll be the structure of those commissions and whether or not trail stays. And I'm very confident it will, because we've put a good case and a good argument up as we have previously to sustain it. It creates an accountability structure for brokers as well. The argument is that you get half of your upfront, and then you get the rest as down the track, and it ensures that what you're putting the customer into in terms of the structure and the nature and the lender is the right one, because you're putting half of your income at risk if you don't do that correctly.
Yeah, no, that's good. And something I wanted to pick up on there that you were just mentioning was the upfronts, which of course we've heard some talk that the industry may be addressing upfronts, changing those around, looking to do something with upfronts. What's your sense of that conversation right now and maybe where that's headed?
No, look, there's no need to change the upfront structure as it is. I mean, there is definitely a significant linkage between an upfront and a clawback, because that's obviously the bit that gets clawed back. To remove a clawback entirely, a lender will probably want to reduce that upfront significantly. There's some of the structures, but no one's really talking about that from that perspective. We did see Bank West reduce their upfront from 70 basis points to 65, but that was also as they're also taking away a clawback component of their review of the further payment of that upfront. So they were one of the lenders that would pay more if more funds were drawn down or utilised, but they were also going to claw back if extra funds were put into the offset account or were paid off the loan, in which case they're not doing that anymore. And so they readjusted their upfront to balance that out. That being said, there is an argument that lenders should be increasing that upfront base rate because they're paying out a lot less commission, given that it's being paid out on the utilisation or net of offset component as well. And that's something that we've had discussions around, but I'm not sure how much movement we're going to get on that in the current environment.
Yeah, well, it's obviously to be continued, and I know that seems to now be the next big conversation from what both you and Tanya and Blake have sort of alluded to. I wanted to go back to something you said a moment ago, and that is the fact that Connective is now one of the largest aggregators in Australia. I can't recall whether is the AFG thing happening or not. I think you got one of the first hurdles out of the way, but is it still proceeding?
Yeah, look, at this stage we're still proceeding with that. There's some legal obstacles that we're just working through. Yes, we've got, we're never getting an approval from the ACCC, but they're not going to block it, is sort of how they work on it. So it's sort of, I guess, it's got the green light from that perspective. But yeah, we've just got a couple of legal things to resolve, and yeah, then we sit down and look at how we move that forward.
Well, that's fantastic. And how many brokers will that actually sort of mean for the combined group? Roughly.
Well, I have to rethink this because we've been working on this merger for a long time, but we're currently sitting close to 3,800 ourselves, and I'm pretty sure AFG have got close to 3,000, well over 2,000, close to 3,000 as well. So,
okay.
It's a significant number, but the objective is to have the two different business models and create a sort of a larger group, which within that shareholding structure that AFG has already got, that creates an opportunity from that perspective. And of course, we want to make sure that we can get, a better industry for brokers. And so obviously we'll want to make sure we leverage the combined value of those businesses, the combined force of those brokers and the business that we do to ensure that we achieve better outcomes for brokers in the industry.
That's fantastic. That's music to my ears. And I'd like to pick up on that. I don't know how much you can maybe tell us about, but are there any broad brushstroke things you can, share with us that you would be looking to do once these entities are combined and you do have that tremendous bargaining power and pricing power and other things? Like what are your, so what's the hit list, as it were, that you would go to lenders and say, okay, guys, we got, 7,000 brokers now. You need to kind of do what we want, sort of thing. Is there any big issues you want to tackle?
Well, look, that channel parity is a crucial thing. Having, the same standards, whether you're a broker or whether you're dealing in the front line of a bank. I'd almost argue that they're better off spending more time, effort, and money with the broker channel than they are with the proprietary channel, because we can turn things around faster, make things happen, and we can actually be more efficient than what their branch channels will be. Plus, we'll be delivering as a much better service because we have a best interest duty, and their bankers don't. So they've got a code of banking practice they've got to adhere to, but brokers we got a lot more scrutiny. So I think we're in a better position to service the customer. So channel parity is crucial. As I'm going through the Cross City Tunnel, as you could probably tell, hasn't turned to night all of a sudden. And just also that fairness around commission structures as well. What we've got to make sure as an industry is we've got to also make sure it's valuable to the lender. If we take away too much value or take away too much ability for the lender to earn their money, then they will go and find other ways to try and originate that business. So we've got to get that balance right from that perspective.
Okay, no, that's good. Well, I'm very, very curious to see what 2021 is going to bring in a lot of respects. Something I wanted to ask you your thoughts on, because we sort of had this conversation both with Tanya and with Blake, and that is this concept of our role in the transaction. And we've got a variety of views on the spectrum. I actually think we're advisors. I've had a bit of pushback from some of our members that's saying, no, we're not advisors. And Blake and Tanya both are of the view that we're not, we just recommend products. Where does Connective, where do you stand in all of this?
Well, this is my own personal stance. From a Connective point of view, I'd probably have to defer to my group legal counsel, Dano, but he would work on the back that, we're originators from that perspective, using the terminology. We're an intermediary. But I think we should challenge ourselves and sort of, we're with the best interest duty, we're essentially being held up to the same standard as an advisor. And so we should, while not necessarily putting time, we should think of ourselves that way and be accountable in terms of our actions and our behaviours in that way. And you talked about it in the transaction. I think the key part of a broker, it's all about the relationship. This is the difference between a mortgage broker and a bank, and a good mortgage broker and a not so good mortgage broker. Good mortgage brokers think about each loan as part of a relationship with a customer, not about just doing the transaction and doing the loan. They're thinking about it as an ongoing journey that does not finish when the loan is approved or when the loan is settled or when you get paid your commission. It's an ongoing process from that perspective. The great thing about best interest duty, though, and one thing that I know working with Mike Felton, we argue very hard for, is that keep in mind that best interest duty only applies when you are providing credit assistance. So you can do scenarios for customers. You can look at various options for them, but you don't work in a best interest duty full mode until you're sitting down and you're saying, right, you're applying for more credit, we're going to refinance you to another lender, in which case I'm now providing credit assistance. So my full best interest duty requirements kick into gear, and you go from there. But that being said, you need to document every single interaction with your customer, even if it is not part of a credit assistance. Just keep a copy of your correspondence and the conversation so that you have that to hand.
Okay, no, that's fantastic. And that's a common theme we've heard from all of our aggregator heads today is really documenting things well, doing your due diligence and making sure that you've got, good file notes and stuff, which, for an industry that has come from the heady days of you had a heartbeat, you could get a mortgage, to now where we're almost like financial planners. It's refreshing to hear that from all three of you. Now, Michelle has got a question for you, or asking for a comment on the ASIC changes around conflict of interest for ACL holders versus ACR or credit reps and breaching process. So I don't know if you've got any commentary around that you'd like to share with us.
Yeah. Look, there's a specific component of the guidance that ASIC issued in respect to best interest duty and the conflict priority rules, and it calls out ACL specifically. And I think it's doing that just to ensure that ACL providers are making sure they're thinking about that. So in their business models, as an ACL, you've got to think about various things that could be creating conflicts for you in terms of your business and in terms of the way you're managing your credit reps under you as well. So that's a sort of it's a very broad theme, as most of ASIC's guidance is. And so that's where it comes to. Now, Dan and I are going to be doing a webinar specifically for ACL holders coming up, and obviously PJ, yourself and all that will be able to jump on that and obviously take that content and filter it down to your members as well. But we'll be pulling that apart. We're still having regular dialogue with ASIC just to get a few things cleaned up. But yeah, we do want to know what more specifically does it mean. But if you're approaching your business as you would as a credit rep, as you would as an ACL, but think about how that then flows into the control mechanisms you've got for your credit reps under you, and your responsibility to make sure those credit reps are doing all the right thing, are meeting the best interest duties, and any conflicts that are around the business. And an example there, and they give this example in terms of relationships with other parties, so if you've got a relationship with a developer or an insurance company or a real estate agent, then how the rule there is, how would someone who didn't have this conflict approach this situation? Mm-hmm. And you've got to basically handle the client relationship as if you didn't have that conflict hanging over your head.
Okay, good tip. Now we've got you for maybe another minute or two, and I really do appreciate you taking the time today. I know you're on your way to an appointment, so if you need to bail, please do. But any final thoughts from you, if you want to tell us a little bit about Connective and what's coming up next year? Anything you'd like to share with us before you jump off?
Yeah, look, I think next year is going to be a very exciting year for us. Obviously, as we get a vaccine, as we're about to get out and move around, make sure that you are enjoying that, but making sure that you're still focused on your business. There's one massive thing we want to learn from this year in 2020, and that came at the beginning when the pandemic hit. Customers couldn't get a hold of the banks. They were really relying on brokers. Then there was all these really good cashback offers and rates in the market. So brokers were getting inundated with inquiries, and the competition was strong. That was the one thing. When you started talking to your customers, you got more business. And I think that's something as brokers that we kind of have drifted away from. We're so focused on whether it be compliance or what's happening with the Royal Commission. We forgot the key component of maintaining that contact, and that even that physical contact in terms of a phone call, or in this case, you know, a Zoom meeting or a Teams meeting or whatever it might be with your customer. Keep talking to them, and surprise, surprise, you'll actually do more business. So I think that's got to be something that we look at and make sure we continue to do in 2021.
Very, very wise words from a man who's been in the industry a very long time. That sentiment was echoed by I think both Tanya and Blake as well. And it's a message we started our meeting with as well, which is more communication. Talk to your clients. Guess what? As you said, surprise, you're going to write some business. So once again, Mark, I really appreciate it. Thanks. I know you're rushing there to get to your next appointment. I'll give you some time to decompress from this before you go into that. But really appreciate it. Ladies and gentlemen, put your hands together for Mark Heron. Thank you for joining us. And we'll see you around the traps, no doubt.
Thank you all.
Cheers, mate. See ya.
Bye.
All right, guys. Well, that brings us almost to the close of today's meeting. And I might actually just get Rocco. I don't know if you're still in the house. It looked like you were back in Australia when I saw your screen, and not in Italy anymore. Are you there? There you are.
Yeah. Been in the 14-day quarantine section.
Yeah, I know. I tell you, it's a pain, isn't it? Hey, what's going on at Your Mortgage?
Mate, it's same old, same old. I'm quite happy that the banks are taking 3 and 4 weeks to get answers back because the brokers are coming back to us. We're doing it in our typical 3 days. Look, it's business as usual, going strong, and actually looking forward to a Christmas break for once. Yeah,
that's good. Fantastic. Well, there you go. 3-day turnaround from Your Mortgage. So if you're not, if you're struggling with someone else, give Rock a call. I'm sure he can help out. Alvin, you're eating something, so of course I'm going to go to you right now. So quick, chew faster, swallow. What's happening, or maybe Greg, I don't know if he wants to jump in and tell us what's happening in your world over at, your neck of the woods. Oz Loans. Take yourself off mute. Greg or Alvin? Nothing's going on. Okay, Greg, he's handballing to you, bud. It's a hospital pass. Cleaned up.
Hi there. We've been talking to some brokers who might join us. And we've got the brokers we've got are quite busy, really. Some complex loans with this FHLDS, which is now called a New Home Guarantee, I think. So at the moment, as the other guys have been saying, full steam ahead.
Okay, well, that's good. I think you must have 2 devices on because we're getting a lot of feedback from you, so I'm not sure.
Oh, sorry.
That's okay. You're on mute, but you've got a phone going, I guess. Anyway, guys, we are almost at the end of our meeting. It was fantastic to see you all. It's been a pleasure. We've had pretty much a consistent 45 to 50 people joining us. We had about 80 registered for this meeting, so I'm not sure what happened to 30 people. Maybe they're all taking advantage of this wonderful weather and down at the beach or on the golf course today. But we've certainly learned a heap of stuff, and I think hopefully you'll agree with me that most of the aggregator heads all had a very similar message in terms of the things we sort of pinged them on and discussed with them. So good to see. I think the debate of whether or not we're an advisor, we'll have to pick that up over some beers at the McCure in November and have that conversation and flesh it out. Again, just a reminder, today will be the last day that members get preferential registration. So if you're not a member, please register to be a member and then register to go to the Christmas party. This is for the Christmas party, by the way. After that, it's going to be opened up to non-members to come. And of course, I'll be in touch with a couple of you. Somebody is still not muted, but I'll be in touch with sponsors to advise you as to what your allocation is. Unfortunately, it's only going to be 1 ticket unless, of course, we don't have the full meeting attended, or party attended by 70 people. We'll open it up a bit more, but we're looking forward to seeing you as well at the Christmas party. And guys, ladies and gentlemen, thank you so much for a wonderful year. We survived COVID. We survived getting this thing on Zoom. And hopefully next year, 2021, will be a good one for all of us. I look forward to seeing you at the Christmas party if you're attending. And if you have any questions about any of that, you can ping me or any of the steering committee members. Umit is heading up the Christmas party committee and dealing with all of that. So ladies and gentlemen, thank you so much. Have a wonderful weekend. And we will see you, I do hope, at the Christmas party. See ya.